I've got an interesting one for you today, folks, if not a little bit of a scary one that could signify that we haven't reached the end of the deflation of the Canadian real estate market. You see, we've hit a major inflection point with something happening in Canadian mortgages that has just flat out never happened before, while at the very same time, an individual mortgage company is freezing funds. And that is exactly what we're going to talk about today, so let's get into the details, take a look at this. We're going to be talking about this chart, making sense of it, and something that I'm calling the line of no return, which looks like this. Let's zoom in so you can see a little bit more clearly, and if you haven't already, make sure to subscribe to the channel so you can keep on getting Canadian updates like this. This chart is tracking three very easy to understand things. The first one is the blue line. That's a 5-year fixed mortgage rate. That just shows the interest rate that you'd be paying on the most typical mortgage here in Canada and how that changes over time, right? The green one, very similar. That's just for a variable rate mortgage, one of those mortgages where the interest rate actually changes along the term of your mortgage rather than it not changing until you have to renew your mortgage, right? It'll just float along with the rates as they change. But the third line here, the most interesting one, is the stress test. This gray line here that you can clearly see. And this shows where the stress test is at any given point in time. But let's get a little bit of a better understanding on what this stress test is, and why this is going to have such an impact when we start talking about this line of no return. The stress test was brought into Canada back in 2016, and the idea of it all was to make sure that people, when they were getting their mortgages, would actually be able to qualify for a higher mortgage rate than the one they're going to have to pay, just in case interest rates go up in the future and they're forced to pay this new higher rate. And you can see where the stress test starts to come in here on this chart. You can see back in January of 2016, even though interest rates were around just under 3%, people had to qualify up at 4.75% in order to actually get the mortgage, even though the interest rate was way lower than what they were qualifying for. All of the people who have qualified for loans in the past couple of years, this line right here is April 2020, and this one is July 2022, October 2022. All the people that have qualified at these lower rates, well, now interest rates where they are today are crossing the line that they were stress test for, meaning that their income now will not support the loans that they need to continue owning their homes. But you might be saying, Russell, aren't most loans and mortgages over 5 years? And we don't have to really worry about that right now, at least for the next 3 years, because people's payments are locked in, and you'd be right. But there is a perfect storm that's happening right now in the area of the shorter term mortgages between 1 year and 2 years that are about to come due that could cause a large problem, and they're actually more common than you might think, especially in the past couple of years. But that is where the plot thickens, because one of the largest companies that provides these shorter term private mortgages, that's Romspin, well, they're having large problems related to this crossing of the line of no return that we were talking about that has caused them to have to freeze funds, and this could be the first domino that leads to an unraveling. Romspin is one of many private mortgage companies which a lot of people have been leaning on in the past number of years. When people can't qualify to get a home at a traditional lender like one of the big banks, Scotiabank, TD, CIBC, the banks that have the toughest requirements in order to actually qualify for a mortgage, oftentimes people will turn to what we call B lenders, which would be credit unions or other sort of organizations like that. Some people don't even qualify for mortgages with those B lenders, so they're forced to look to private lenders as a last resort. These private lenders are usually a lot more lenient with the qualifications and the various stress tests that need to be done, and they make it easier for people to qualify for mortgages. But for the people who are buying houses, this is a last resort, because the interest rates that these private mortgage companies charge for people are often far higher than the traditional market rate at the time. They also can include additional fees, so most people don't want to go with these lenders, at least for the long term, right? But what they might choose to do is to go with this type of lender for the short term, and that is what Romspin actually specializes in. So these potential homeowners will talk themselves into going with a private lender, saying, hey, I just need a couple of years to get my credit in line, or I need a couple of years to increase my income, and maybe at the end of this short-term mortgage that I'm getting with the private lender, rates will be lower, and I'll be able to just refinance with one of the A lenders, those big banks that'll give me a better rate in the future. And that's what you're seeing right here. This is showing the maturity of these loans that RomSpin is giving out. That's essentially when the loans come due, or the period of the mortgage. Most are under 1 year. That's the blue segment here. 1 to 2 years is gray, and then they barely even deal with any mortgages over 2 years, the small little yellow sliver here. But there's a big problem, right? Because we've crossed this line of no return, interest rates are far higher than they were a year ago, even 2 years ago. So when people come time to get rid of this private mortgage lender, when they typically would qualify for a refinance to go with an A lender, these better rates, well, they're just not able to, because if they weren't able to afford a home 2 years ago, certainly now when homes are even less affordable, they're not going to be able to qualify for a mortgage again. But regardless of if they can qualify for a better refinanced mortgage to get away from the private lender at the end of the 1 year or the 2 years, depending on how long this mortgage is, they come a knocking saying, hey, where's my money? This loan was only for 2 years. You said you were going to pay me back. Where's the money? And right now, with the rising cost of living and these people backed into a corner, which in some senses they kind of put themselves in, they're saying, hey, RomSpin, I don't have the money. What am I supposed to do? I don't have the money to pay you back. I can't get a refinance. I could sell the house, but I'm not going to do that. So I guess you're going to have to try your luck taking me to court to get the the foreclosure process started, which these companies don't want to do, because in Canada, that can take 6 months or longer to actually get through the courts. And that is why RomSpin has had to freeze funds, but not the funds of the homeowners, no, the funds of their investors. Let me explain. RomSpin has the money to fund all of these mortgages, to give people these mortgages in the first place, because they've asked investors to buy into their fund. They say, hey, you can give us your money and we'll give you an 8.3% return on your money, and we'll make these mortgages with the money that you give us, and they've got to pay us these high interest rates, so we'll just pay you a portion of the interest rates that they're paying us, 8.3%, and hey, that sounds like a pretty good investment. But all of a sudden, it becomes a less good investment for the people who are putting their money into this fund when RomSpin says, actually, we're not going to give you your money back, at least not for now. That's why so many people were so pissed when headlines like this broke just this week. RomSpin halts redemptions on its largest fund. A significant share of borrowers have stopped making their payments. And there is a lot inside of this article, and a lot of it is rather heady corporate speak, but we're going to break it down because it's actually not a complicated situation. They sent a letter out to their investors saying that, hey, we're going to temporarily defer payment of redemptions, essentially saying if you wanted to take your money out of this fund, well, we're just not going to let you for now. They then go on to say loan payoff activity remains suppressed. Please be assured that we are working diligently to expedite the number of these portfolio transactions and remain confident in the underlying value of the fund's assets. Okay, this in plain speak, loan payoff activity remains suppressed. People who they've given these mortgages to are just not paying the mortgages anymore. They're saying we're trying to go as fast as we possibly can to get money from these borrowers that aren't paying, but in many cases, however, such transactions involve coordinating the interests of a number of independent third parties who are also affected by the present market uncertainties, essentially saying, hey, we're trying to maybe foreclose on these people or get them to start paying again, but they're in a crappy situation where they don't have any money to pay us in the first place, and we don't really want to take them to court to get a foreclosure going here. And this is where things get shocking, because they say that approximately 40% of the people that they've given mortgages to have stopped making interest payments. So they're saying until either we get these foreclosures rolling or we get these borrowers paying us again, we're not going to be able to give investor money back. Obviously, that's a huge deal. But I'm sure not a lot of people are crying for these very wealthy investors that are giving money to the private mortgage funds. But what's most interesting about this is what it tells us about those very people that got mortgages before we had crossed that line of no return. With 40% of the people who borrowed from this private mortgage fund not being able to make payments on their properties anymore, this could be a sort of canary in the coal mine for this to be happening on a far more widespread level. My guess is that RomSpin isn't going to be the only private mortgage company that deals with this. And if the Bank of Canada increases interest rates again another 0.5 percentage point, then we're going to just see this line go up further and further until they start changing their mind about what they're doing with interest rates. And the farther and farther we get past this line, and the more and more time that goes by, means more people are going to need to re-qualify for their mortgages all over again in a situation where they just might not be able to qualify anymore. So you can see how this could potentially lead to a messy situation, but it remains to be seen, and this is if this is going to be something that's widespread. But I'm curious what you think about all of this. Let me know down in the comments. What do you think of this private mortgage company freezing funds of their investors? Is that something that you expected to see? Or do you think that, hey, maybe some of these people that have gotten into these mortgages are in this situation as a result of their own actions, so they should have to deal with the repercussions themselves? Obviously, things are going to shake out in a number of different ways over the coming years. But there's one thing that is certain, and that is that as these things are rolling out, I'm going to be right here breaking it down for you. So if you haven't already done so, make sure to subscribe to the channel. It helps out the channel dramatically and helps support more Canadian content like this being made on the YouTube platform. But with all of that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.